as a young population which has grown up with mobile technology, one would think that the banking sector would be more buoyant. Yet the recent decline in bank share prices has investors on the edge. Of course, part of the reason is that markets are in turmoil. Some of the greater decline of bank share prices can therefore be explained by the fact that they're seen as a leverage play on the economy. Bad days, they move down more. On good days, they move up more. And that's what we've seen recently. It doesn't mean that it'll hold forever, but certainly it's something that one can observe. With markets generally in decline, the decline in bank share prices has been more accentuated. However, part of the reason is, of course, that some bank results, mainly public sector banks, have not been, to put it mildly, pretty. Clearly, an important factor has been the asset quality review conducted by the Reserve Bank and its aftermath. So what I want to speak on today is to explain the rationale for the AQR, the process, and what I believe will be the outcome. I'll also talk a little bit about liquidity at the end, an issue which has been of some concern to markets. Now, over time, as you know, a number of large projects in the economy have run into difficulty. Reasons, as Mr. Mundra articulated this morning, include poor project evaluation, extensive project delays, poor monitoring and cost overruns, and of course the effects of global overcapacity on prices and imports. As a result, loans to these projects have become stressed. Now, there are two polar approaches to loan stress, and of course a lot in between. One is to apply band-aids to keep the loan current and hope that time and growth will set the project back on track. And sometimes this approach does indeed work. But most of the time, the low growth that precipitated the stress persists, and the fresh lending that is intended to keep the original loan current grows. Facing large and potentially unpayable debt, the promoter loses interest, does little to fix existing problems, and the project goes into further losses. An alternative approach is to try to put the stressed project back on track rather than simply applying band-aids. This may require deep surgery. Existing loans may have to be written down somewhat because of the changed circumstances since they were sanctioned. And if loans are written down, the promoter brings in more equity and other stakeholders like the tariff authorities or the local government chip in, the project may have a strong chance of revival. And the promoter will be incentivized to try his utmost to put it back on track. I use the word he because most of our promoters are male, but read he, she into that. However, to do the deep surgery, such as serious restructuring or writing down loans, the bank has to recognize that it has a problem, classify the asset as a non-performing asset. Think, therefore, of the NPA classification as an anesthetic that allows the bank to perform extensive necessary surgery to set the project back on its feet. If the bank wants to, however, claim that everything is all right with the loan, it can only apply band-aids. For anything more drastic would require NPA classification. In other words, loan classification is helpful for the medium-term health of the project. It's also good accounting. It reflects what the true value of the loan might be. And when it is accompanied by provisioning, it ensures the bank sets aside a buffer to absorb likely losses. If the losses don't materialize, the bank can write back provisioning to profits. If the losses do materialize, the bank does not have to suddenly declare a big loss. It can set the losses against the prudential provisions it has created over time. In such a case, the bank balance sheet represents a true and fair picture of the bank's health, as a bank balance sheet is meant to. Of course, we can postpone the day of reckoning with regulatory forbearance. But unless the conditions in the industry improve suddenly and dramatically, the bank balance sheet presents a distorted picture of health, and the eventual whole becomes larger. Now, in 2008-9, after the global financial crisis, certainly responding to a variety of concerns at that time, the Reserve Bank agreed to forbear on certain kinds of stressed loan restructuring, believing and hoping that this was a temporary need pending stronger growth. Unfortunately, for a variety of reasons, the stress has not been temporary, and growth in these sectors proved elusive. So early in the process, we set about giving banks the tools to deal with stressed loans, including information about the degree of the borrower's collective indebtedness from the system. This is the CRILIC loans information system, and more effective ways of reducing the project's financial stress, such as the Joint Lender Forum, the Strategic Debt Restructuring Mechanism, and the 525 mechanism. In a way, we've been trying to create a functioning resolution process in a situation where the existing bankruptcy system does not work well. Of course, every new tool can be used to deal with a problem, but also perversely to avoid it. So after giving banks the tools, the RBI ended forbearance in April 2015, as it was scheduled to end, advertising the ending fairly clearly, and then started the asset quality review to ensure that banks were taking proactive steps to clean up their balance sheets using the tools they now had. Working with the banks, our supervisors, led superbly by our head of banking supervision, Ms. Parvati Vairasundaram, our Executive Director for Supervision, Ms. Meena Hemchandra, and of course our Deputy Governor, whom you met earlier today, S.S. Mundra. This team identified loans that were of concern, as well as loans that had potential weaknesses from the CRILIC database and from discussions with the banks. For the loans that are of concern, the banks are attempting to regularize the loans that can be put back on track and are classifying those that cannot for deeper surgery, so again, they can be put back on track. They are taking provisions in accordance with the degree of stress extent in the loan. So it relates to how much stress there already is in the loan. They will also make provisions for loans that have possible weaknesses going forward. Our intent is to have clean and fully provisioned bank balance sheets by March 2017. Of course, an immediate question that people in other countries would ask is, why not do everything in one go rather than over a period of 6 quarters? Is this kind of Chinese water drip torture? And the answer is no. It's precisely because a number of these loans can be regularized or stabilized when weak but regular through the right collective actions that we are allowing banks time. Sometimes an NPA classification, as many bankers tell us, even while permitting deeper surgery, prompts risk aversion on the part of bank boards, and they stop lending even when the project is viable. We have no intent to precipitate this, but we also have to recognize as a system that we need to overcome this view. We have issued circulars stating that a loan to a project where other loans are NPA does not automatically become an NPA, and certainly one could consider giving such new loans priority. But this change in attitude in the banking system will take time. Pending that change in attitude, which I think will come, as banks turn to unlocking the value in the NPAs, we are working with them to sequence the most obvious actions up front, which is reflected in the results that you've seen recently. However, the end game is clear to everyone and is bounded. We do not envisage a sequence of AQRs and a further identification of a fresh set of loans which need to be dealt with. Having pointed out the contours of the task to be accomplished, our teams are working with the banks to ensure that they're all broadly on the same page in terms of recognition and provisioning, even though each one has flexibility on individual cases. This means that the December 2015 quarter results can be broadly compared across banks to get a rough sense of the task each bank has to accomplish, with only one caveat, which is that some banks have expressed an intent to clean up their balance sheets even faster so as to put the problem behind them, and we have not held them back. We have not put out any of our final estimates, as some have suggested, because we believe that it is a moving target with more bank action, promoter response, and growth diminishing the eventual cost in terms of NPAs and provisioning. It's important to recall that underlying many of these stressed loans is an economically viable, productive asset, not ghost townships. A lot of work has gone into this review, including many meetings with the government at every level, including the highest. The government has been fully involved and supportive. We've mapped out a variety of scenarios on possible outcomes. The finance minister has indicated that he will support the public sector banks with capital infusions as needed. Our estimate is that the government support that has been indicated will suffice. Our various scenarios also show that private sector banks will not want for regulatory capital as a result of this exercise. Finally, the RBI is also working on identifying currently non-recognizable capital that's already on bank balance sheets, such as undervalued assets. We could allow some of these to count as capital as per Basel norms, provided a bank meets minimum common equity standards, and we're working on analyzing this. Now, with this market turmoil, there are some wild claims being made by some financial analysts about the size of the stressed asset problem, which I think verge on scaremongering. Our projections are that any breach of minimum core capital requirements by a small minority of public sector banks, in the absence of any recapitalization, will be relatively small and contained. In other words, the extent by which they breach will be relatively small and contained. They will need government equity or preference share infusion, since they are typically banks that will find it difficult to raise equity in the markets. But as I said, there is government capital available, which will come. A few others will need a top-up of their capital to ensure that they have a reasonable buffer over and above minimum capital requirements so that they are prepared to support the growth. Again, what the government has already explicitly committed is, in our view, enough to take care of all reasonable scenarios, and the government has further committed to stand behind its banks to whatever extent needed. The RBI will provide whatever liquidity is needed by any bank that needs it, though we don't foresee such liquidity needs. In sum, while the profitability of some banks may be impaired in the short run, the system, once cleaned up, will be able to support economic growth in a sustainable and profitable way. The economic assets of our public sector banks, such as the trust they're held in by the population, their knowledgeable employees, their location and reach, and the low-cost funding they have access to, can then be fully realized. Now, people sometimes ask, why now? Why now? Why did we have to pick this period of global market turmoil for the banks to start cleaning up? Why not let growth take care of the problem? Now, as I've already said, the process started in April 2015 and was very, very far along by the time this turmoil started in January. We knew at that time that the global economy would continue to be weak. Nevertheless, the market turmoil, which has emerged recently, simply reinforces our belief that we needed to act when we did, because things would not turn around magically, that in fact weakness would persist for some time, and cleanup was extremely important. But there's another important reason why this cleanup was warranted now. While growth will help the system, growth will not emerge unless the cleanup is properly done. It will not emerge to the full extent. Of course, we're already growing at a strong pace, but it will not emerge to the full extent unless the cleanup is done. And just to give you some numbers, non-food credit growth from the public sector banks, which is the most stressed part of the system, grew at only 6.6% over the calendar year 2015. Industrial credit growth, this is to manufacturing companies, was only 3.3%, while growth in lending to agriculture and allied lending was only 10.4%. This is usually where they have comparative strength. The only area where they grew reasonably was to personal loans, where growth was 16.9%. Now, in comparison, look at the private sector, which is less encumbered with stressed assets. Non-food credit growth was 20.2%, again, compared to 6.6%. Growth in agricultural and allied activities was 25.4%, enormous difference from the 3% in the public sector banks. To industry was 14.6%, again, big difference. And to personal loans, where there's the smallest difference, was 23.5%. Here the difference is only about 6%. In the other areas, it's over 10 percentage points, over 10 percentage points difference. What this means is that because, this is the only reason I can think of, because of managing the stressed assets, so far there is no shortage of capital for the public sector banks, because of the issue of managing the stressed assets and potentially some risk aversion as a result, public sector banks have curtailed their lending relative to private sector banks. Now, what is the appropriate pace? Is it the pace at which the private sector banks are going, or is it the pace at which the public sector banks are going? I will leave that as a question, but my sense is, without going much further into the analysis, that the message is very clear. We have to clean up bank balance sheets to get the growth that will further help the bank balance sheets get restored to health. So I think the process has to start, and it'll become a virtuous circle, which will end in much healthier banks, much stronger support to growth. Indeed, this is the lesson from every situation of financial stress that one has studied across the world. This used to be my area of academic specialization, and I think the answer is clean up as soon as you can, because then you restore the growth. Don't rely on growth, because it depends to some extent on the cleanup. Now, some citizens are outraged by the size of the losses that have to eventually be absorbed and want the perpetrators to be brought to justice. Now, let me emphasize that all NPAs are not because of malfeasance. Indeed, most are not. Loans can go bad even if the promoter has the best intent and banks do the fullest due diligence before sanctioning. Nevertheless, where there is evidence of malfeasance by the promoter, it is extremely important that the full force of the law is brought against him, even while banks make every effort to put the project and the workers who depend on it back on track. That is why we've strengthened the fraud detection and monitoring mechanism and look forward to the banks in the audience to help make it more effective. Now, there's a lot of action that is being taken. The government is taking direct action to clear bottlenecks and revive stalled, stressed projects, and it intends to support some of them with equity infusion through the National Investment and Infrastructure Fund, much as was suggested in one of the presentations. Private, well-funded players are looking to buy assets, and in recent weeks, we've seen some promoters sell assets to raise money to pay banks or to infuse in projects. I think all this activity bodes well for the success of the cleanup. Now, of course, as we clean up, we must make sure that this doesn't happen again. The government, through the Indradhanush initiative, has sent a clear signal that it wants to make sure that public sector banks, once healthy, stay healthy. So strengthening board and management appointments, decentralizing more decisions to professional boards, finding ways to incentivize management, all these will help improve loan evaluation, monitoring, and repayment. We ourselves are looking at regulations that impede attracting good people into these positions, and we will see what we can do in making it easier for good private sector players to take part in the process of governing our public institutions. Banks also, our public sector banks, but our private sector banks also, must review their procedures to ensure they can make good credit decisions. The new bankruptcy code, when enacted, will give creditors a way of collecting repayment through the judicial process in reasonable time. It will also give the out-of-court resolution that the banks have developed more teeth, because in the shadow of that process will be a bankruptcy process which they can use to enforce their claims. So my hope and belief is that the next time will be different for public sector banks. They will emerge from this cleanup stronger and more capable. Let me turn to a final issue unrelated to the AQR, that is system-wide liquidity. Now, the RBI has been infusing plenty of liquidity in the system to offset seasonal build-up in balances, including government balances. Indeed, money market rates have dipped dramatically on some days because of the liquidity infusion. Nevertheless, market participants have complained about a system-wide shortage of liquidity. Now, we're an open central bank. We called a number of market participants in to discuss their concerns. And while we are still trying to understand which of the concerns have merit and can be addressed, we're acting today as of 5 o'clock, or 5:30 I should say, that's when our circulars come out, on one issue that we were cognizant of, the use of SLR bonds to meet liquidity coverage ratio needs. The circular was in the works. We expedited its issue because of what we heard from the participants. As of today, we will allow banks to count 3 percentage points more of their SLR holdings towards LCR requirements. In that sense, for most banks, LCR will cease being binding. More detailed announcement will come out in a few minutes at 5:30. So in conclusion, I think the market turmoil will pass. At some point, after there is blood on the street, market participants sort of breathe the air and say, well, the world still carries on, and maybe we should get back to discriminating between investments. I'm also confident the cleanup will get done, and Indian banks across the board will be restored to full health. While we should not underplay the dimensions of the task, we should all be confident that it is manageable, and the government and the RBI will do what it takes to make sure that banks are able to support the tremendous growth that lies ahead and that you've talked about in this conference. Now, finally, on the presentations that were made, I rarely comment on suggestions, but we'll take them on board, and after due thought and deliberation, let's see what we can do. Thank you very much.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.